to the SFX30 roots and do some simple math. So there we are for tonight. I guess the first thing I want to think about is old school SBT10 and SFX30. And the first thing we want to look at is in the old paradigm, the old school way of looking at things. They had big stops, we had lagging indicators, yawn, yawn, we all know that. They had stops, yawn, yawn, we all know that. And the way they viewed life was with winning percentages. If you were to talk about, hey, Billy Bob, I just started this new model and it's really working good, the first things out of their mouth is, what's your winning percentage with it? And they saw everything in terms of wins and losses. And it kind of makes sense. They had a trend going in their direction, or they were going to follow the direction. They have an entry. They have a stop loss, which was pretty big, depending on the trade or time period. It could be 50, could be 100, could be 200. Seen some 4-hour scanners with 175. And they looked for something in their trades. Their TP1, not drawn to scale here, their TP1, if they took 10 trades and they won 6, of course they were 60%. And they never wanted to be, the wins and the losses were never matched. In other words, you didn't win 30 pips, and when you lost, it wasn't 30 pips. So they put you on this essentially wild goose chase and introduced this concept of risk reward, where they wanted you looking, 2 to 1 was like kind of the bare bones minimum, or maybe don't even take it. They're looking for 3 to 1, etc. Because they want that one loss that's 50 pips, they want the victory to be 150. So they still have good profit making when they win 6 and lose 4. But the new paradigm, we have to remember that's just not the case. And specifically, I want to draw your attention to SFX30, where we're using 10 pips in our 2% to calculate, our position sizing, but we're not really using the 10 pips as anything. We use it as our emergency stop loss. So most of our trades, we're going out at -3 at our manual stop loss. Now, even though we're going out at -3, we're still using 10 to calculate position sizing for our 2%, which means when we go out at -3, we're actually going out at 0.6%. 0.6%. So essentially, we get to lose 3 times before we equal our 2%. Now, what's happened over the last many months is I've done a good job at teaching everybody how not to lose in a trade. But our RAS has become so focused that that's our mechanical thing. And something bad has happened in that process. We have learned to psychologically see -3 as a bad thing. We've talked about if I get into a trade and the best I could do is -3, we should celebrate. Do the Charlie Brown dance. right? We don't want to go hunting for trades that are going to give us a -3. So we have to keep that in mind. But in SFX30, what are we going for? What are we really looking for in terms of trades? What do you guys think if you were to average up, you know, assuming you could get into an SFX30 trade because you were available, if we took SFX30 trades for 3 to 6 months and averaged them out, what do you think the winning number of pips is in an SFX30 trade?
15 to 30.
Average now.
Oh, okay. 25 then. How's that?
No, it's much higher than that.
Okay.
At least you're answering. Thank you, Tim. So for a trade that goes, and when we say goes, we're talking about
50, 50.
Yeah, it's real close to 55 as an average.
I thought about it a bit more, and I went.
Yeah, that includes the trades that go 15 and the trades that go 144, but it's about 55. Now some pairs cough up more than that. The pound's actually closer to 72. And then at the high side, we have the 144. We do have the 233s. We do have the 377s on those 4-hour runs with shallow pullbacks where the 30-minute trade could actually stay inside a 4-hour trade. On the downside, the smallest trade you're typically going to get, you know, where it actually goes something, meaning beyond that 10 pip range of analysis, you know, generally it's a little more than 15. It's closer to about 21. Not trying to make everything Fibbo, but that's just where the numbers fall. So think about that. -3 against 15. So on the downside of what we're looking at, we're already 5 to 1. If we look at the average,
you could take 15 pips to 15 trades to 1, really.
You know, you're looking at what? 125, about 18. Yep.
Yeah.
It's about 18 to 1. That's at 55. 72. We're real close. Three and a 7 is 2, 12, 26 to 1. So these are the pips we want, right? These are the pips we want. We want the 21s. We want the 72s. We want the 144s. You know, we'll even go for the 15. I mean, you know, if we have to. We want those pips. And what's happened is we've gotten so good, and unfortunately we've anchored this to be something to be afraid to get. I don't know how this has happened, but that's the real deal. People want to avoid the -3. And in their effort to avoid the -3, they're not getting these pips. Had some newer traders today submit stuff. Had new traders today submit some new stuff and just nailed it this week, man. Just nailed it. I'm excited. So we're gonna back up some. We're gonna back the tape up, and we're gonna go back to, if I'm SFX30, my mindset has to be I'm hunting these pips. And what's happened is too many people are in it. They're sitting down at the chart, and they're letting the chart determine what it is they're trading. The chart determines whether they're trading SFX30 or SBT10. And we can't have that anymore. So you have to know whether you're trading SBT10 our SFX30. Now we talked the other day, and here you got to make some sense of this. We talked the other day at the 30 wave level and the 240 wave level, and for sure above that. We really benefit our trading by having a PRZ or some significant potential support and resistance. Clusters, multiple lines, pitchforks. So those three things. These could be Fibonacci clusters, these could be harmonic scans, and of course y'all know what a pitchfork is. And the reason it's important to have these is it will affect, or it could affect, and if you're going for these pips, it's going to determine how you trade what we've been calling fan retraces. If I have let me just erase all this. No, I don't want to erase all of it. Not yet. And we're going to stay blue and red. Red supposedly our 5-minute wave here. Price comes up to what is a convergence point. And we know something about that convergence point. We know we're going to enter that trade. So we enter this trade, and well, 2 pips a pullback, 1 pip a pullback, 2 pips a pullback, and this pulls back. We enter the trade. And now, let's say the 30-minute wave is snaking. So we pull back. And we get what looks like a fan retrace. All right? We know it's a snake in the grass at this view. And let's now talk about what we see with price. As we have a pitchfork here. How do I want to do this? So price has, let's say, crossed over the median and pulled back down, and now it goes up. Now we have another convergence. So there was a convergence here, there was a convergence down here, at the bottom down here, or a retrace extreme. One of it doesn't really matter. Let's get to the point here. So I know in looking at this, especially if we go back to our Aussie chart that worked out so well, that from this point here where it checks the median, per Andrew's observations, this thing is headed to the upper parallel. Doesn't mean it's going to get there, but again, we're stacking probabilities the best we can. There's always going to be exceptions, but nobody has a crystal ball, so we just stack it the best we can. So in this kind of scenario, when we see it's a definitive snake, and we see this, what appears to be a fan retrace, normally we're going to go ahead and exit this sell at the bottom. Now, some people may enter a buy into the sell, but we exit our sell. So let's say now price continues to move back up, and there's another convergence. So what happens, obviously, is, you know, this snake continues, and everything manages to come up and converge. And now we have another entry, another sell. So we enter again. This time, the 30-minute wave does something like this. During the pullback. And, you know, we can't really tell, is that a snake? Is it the start of a reversal? Is it the start of a retrace? We're just too young in the move to know what's going on there. You know, in this pullback in price, maybe it pulls back a little bit. And there's just not enough. What's that?
We've entered the trade now.
Yeah, we're in the sell.
Yep.
Both sells. So what we have to do here, even though this looks a lot like this first setup, what we have to do here is not exit. And it's going to be tempting because as this starts to move back up and look like that, you know, this thing obviously is going to bottom out and start coming back up, and we're going to go, holy shit, you know, excuse my language. You know, I was +5 down here, you know. But the problem is we don't know what's going on, you know. Do we know what's going on? We don't know what's going on. And we're in this for the bigger pips. But what can save us here? What can save us here is the fact that we're expecting to get up here with this thing. And because we're expecting to get up there, I can go ahead and exit down here, and I'll bank my +5. Now, I can only do that if I have this line up here. If I don't have a PRZ, if I don't have a reversal point that's really strong, we don't know which one of these is going to be the reversal. So we have to give them a chance. We have to let this thing do its 1-2 move in order to give us a chance. Furthermore, this is different than this. It started to pull back. But again, it hasn't totally left the extreme. Maybe this is going to be a reversal. Maybe it is in the next 10 pips of pullback. Maybe this does show some steepness as a true, make it blue, as a true retracement. Maybe we see disproportionality there. But at the time we're down here, we don't see that. We just see it's pulling back some, but we can't call it anything. The disproportionality between this move and how far it's pulled back from the last harmonic convergence up here, we can't say this is disproportionate. We don't know what this is. So if we're going to take ourselves out down here all the time when we don't have a target up here, no, I'm not talking about this thing being 300 pips away. You know, I'm talking about a pitchfork, and maybe we have a 50 pip channel here. 50 pip half channel, because this is our median line. So if I'm in this area and everything else about this pitchfork is behaving really strong, I'm going to just take Andrew's observation and say, from down here, the next logical place this thing's going is the upper parallel. So because this is up here, I'm not going to believe this pullback is the one that's reversing. Doesn't mean it won't be. But you know what? If it is, if it does pull back from there, what's it going to cost me? -3. And, or in this case, it doesn't cost me -3. I actually pocket +5, but I may give up. But I may give up the 72 pip trade. Okay. So the PRZ point is really important. This is why you want to make the efforts with pitchforks. This is why you want to make the efforts with scanners. So as you're writing these things up, you have some idea of what's going on. If I'm, 20, 30 pips away from a major PRZ, and I'm not just talking, hey, there's one Fibbo from one move. I'm talking about this is a strong Fibonacci cluster. I got 2 or 3 Fibbos crossing, the pitchfork at one point. I've got a scan, and it's got a PRZ that's, 8 pips wide. I've got a pitchfork that's been holding up really well. So I've got a known PRZ. There's no need to stay in these moves at that point. When they come down to the bottom, in one like this, what can I use? Green. In one like this, where we can't quite tell what the 30-minute wave is doing, and we're down here and we're +5, we're +8, we might as well just stay in that trade. Yes? No, we don't want to do that.
What?
We don't want to stay in it, do we? No. Do we? Or do we want to exit?
Oh, I lost you.
What do we want to do? It looks like the 10-minute wave looks like it's retracing. It looks like a fan. But our PRZ's up here.
Nah. We exit.
We exit at the +5. Exactly. When we get to the third one, and the third one looks like this, then we stay because that third one is right up here.
Obviously, even better we enter if we're expecting it to go to the PRZ, we might as well get into the buy into the sell.
Yeah, I didn't want to take it multiple depths but you're right. I'm not taking away from it. It's just I don't want to go that deep right now. My training here is I want to avoid everybody shutting themselves from these pips, which is what most people are doing, because they're exiting every time. They're exiting every time down here. So we want to distinguish.
What you're saying is that on a standard harmonic wave convergence without a PRZ, you must exit like this.
Well, we got a couple of things. We haven't brought in our 10 pip line and stuff like that, but I'm speaking in general terms. If we have a PRZ or some sort of strong reversal point, there's motivation to say that these are probably retraces or snake in the grass or whatever. They're not reversals. Now, if we're too far away from this, obviously we can have a reversal, that comes down and then goes back up to the top. So, we want to be careful with that. And that's why I said there's a relativity to it, a relevance to it, how close you really are to it. But if you have nothing up here to guide you, you essentially have to stay in. It's only when you have something that says reversal and you're away from it that you would want to exit.
Okay, all right.
Yeah, so you're going to want to stay in it for the chance of this. Now look, if you're up +5, this is where the head game is working against you guys. If you're up +5 down here and it comes back up, because we got to let it do the 1-2 thing, right? And it comes back up and it does reverse out and we go out at -3. See, what happens is a lot of you are having headaches because this is what you're doing the comparison with. I was at 5, I went down -3. That's the wrong way to look at it. What you have to look at it is, I'm wagering, hate to put it in betting terms, but I'm wagering -3 against these pips. So here you are in here with risk reward. 5 to 1, 18 to 1, 26 to 1. And remember then, we've got the triple whammy here, or double whammy, because what throws a wrench in all of this to the positive is that every one of these minus 3s, is only equal to minus 6-7%. So it takes 3 of these to equal a minus 2% total. And yet, every 10 pips, because we calculated the stop loss based on 10 pips, every 10 pips, I'm making 2%.
The only problem with that, Steve, the only problem with that is, and your 55 and 72 and all the rest of it, and it's all very true that 3 goes into 15 5 times and into 55 a whole lot more. But if you are missing trades, then you are reducing that percentage hugely, because now you've got a minus 3. It's the same, but you've lost an opportunity. Whereas if you compare
but that's true in the old paradigm too. When they're sitting there at 2 to 1 or 3 to 1, if they miss a trade, that if you want to measure everything that happened and then what percentage of that you participated in, every trader runs into that. That's just reality. But look, I buy a lottery ticket tonight and I win the Powerball or whatever, and I win $350 million. Come Saturday when it plays again, I have the same odds of winning. It doesn't matter that I won today. And if I lost today, that doesn't increase or decrease my odds on Saturday. It's still the same odds every time I play.
That's right.
The risk reward is the same.
Yeah. You got to play the game. You got to play. You got to buy the ticket.
But here's the thing: the bigger picture. What I'm trying to say is, too many people are focusing on their fear of the minus 3. So what happens is it's a law of attraction thing. The more you feel minus 3 is bad, the more you're going to get of them. Why? Because you're trying to protect against the minus 3. So what are you doing? You're taking yourself out in these trades.
Well, you're focusing on the minus 3 and not the win.
Yeah, you're focusing on avoiding the minus 3.
Play to win.
You're doing things like taking yourself out of these trades. Now, taking yourself out when there's no PRZ, you're just operating blindly as an SFX30 trader. Taking convergence, taking convergence, taking convergence. So there's no way you can get 55 if you take yourself out every time. But here's the thing, and this is just something we have to get back to, and that is, if you're trading SFX30, the only way you measure retracement, reversal, and snake in the grass is with the blue wave. See, in SBT10, it's a different story, and we'll get to SBT10 in a minute. In other words, what we've been doing is we see this 30-minute snake in the grass, and we see the 10-minute wave, and the 10-minute wave looks disproportional, and so we call this a fan retrace. And the reality is 50% of the time it is a fan retrace, and 50% of the time it's a cycle. And what we just need to pay attention to is the 30-minute wave. Now, if it's not budging at all, then, this down here would be a great exit. The problem is that's not the only time people are exiting. People are exiting even when it's indistinguishable what the 30-minute wave is doing. So we can't tell the 30-minute wave is reversing here or retracing here, and we're exiting down here because we're saying this is a fan retrace, so we're exiting. This could be a cycle. So we want to go back, if you want to look at your 30-minute chart, do it. And that's the only place we're going to make that determination of reversal and retracement. Now this is opposite. This is SFX30. If you're treating SFX10, different story. because our pips are different. Our risk reward is much less. And if we get down here and we're +5 or we're +8 on a 10 trade, we better take those. But if it's a 30-minute trade, we have to let price do its 1-2 completion and then start coming back down. And we can't get to the 2 completion by exiting down here. So if you're trading SFX30, the only fan retrace really that's, legitimate is when you see the 30-minute wave doing a snake, and you can, it's almost like you can see it on the 5-minute chart. You want to give it that time. Now we're operating in this 0 to 10 pip range. Less than 10 pips. So we've just, and some of it is mine because I've moved everybody through so they wouldn't lose. And I taught everybody to be great non-losers. But in doing so, somehow we just went too far. We got away from true SFX30. Everything's been SBT10, SBT10, and SBT10. And so we're not getting as many 30-minute trades as we should. And it's because of this. We're just, there's the moments where we really can't see what's going on. Now, once you get past 10 pips, even on your 1-minute chart, you're past 10 pips, and your 30-minute wave is way down here. It's at 40%, and in price up here we see it's barely 10. Well, we know that's a retracement, and we're past 10 pips, so we can make a call on it. Top left. Remember now, here's what we have. Who cares about the old paradigm guys anymore? Here's what your trading station should look like from here on after. There's only essentially 3 sets of numbers that it can be. It's going to be -3, +10 and some change, or some minus some change, or plus whatever the 30 trade gives you. We're using, a 40% after 15 pips, a 50% after 20, 25, or the haul, and whatever positive number it generates when it profits you out, that's your third set of numbers. So it's -3. It's around plus or minus 10. Well, 10 plus or minus. And it's whatever big positive number you get from being in a successful trade. We don't see any -10s. We're not going to see any +5s. This is SFX30. SFX30. We're not going to see any +8s. It's +10 or -3. And then once it's +10, this is your trade decision to stay or exit based on how you read the charts. And quite frankly, if you don't see at that point that it is a retracement or it is a snake in the grass, if the 30-minute wave still is very indistinguishable like this down here, I'm staying in until the 30-minute wave shows me what it's doing. Because why? I want these pips over here. So there's a difference between SB10 and SFX30. SBT10, I'm almost always going to want to exit at this, what looks to be a fan retrace. We're not going to say, well, I wonder if it is or isn't, because we're right in the mid-range now, approaching the higher mid-range of an SBT10 wave. So we bank those and trade again.
Sorry, Steve, I'm just a little bit confused. You say we won't see any plus positive 5s, positive 8s. But
Right.
in the previous example where you had the PRZ, you said to take the positive 5.
Yeah, that's bad because and that's why I said I didn't want to get deep, and I said this wasn't taking in the 0 to 10 consideration.
So in that situation, would you take your -3?
Where I have a PRZ? Absolutely.
You're on your way up, okay, and you see a fan, you would wait for the -3. You wouldn't exit at the +5.
Right. It's either going to be
Okay.
above 10 or, yeah.
Okay. All right.
Because see, this is the part people are lacking. And again, I take a little blame for that because we moved through the box. But the box was just there to really talk about the quality of the 1 minute entry. Not too many people, I mean very, very few people have any issues at all with entries. I mean, I'm just totally amazed even in the brand new trader. They're nailing the entries left and right. We don't have problems with the entry. So the box concept down to the multi-wave 10 with a 1 minute wave on it, and we have a 1 minute chart. The 1 minute trigger is working really well. People are making some good decisions there.
It's a head game afterwards.
But it's the head game afterwards. Exactly. Now, one more element here that I want to talk about, and that is in distinguishing the difference between, a distinguishing difference between SBT10 and multi-wave is going to be, well, I'm not going to be able to do it the way I want here. Phone. Is going to be our sensitivity factor to the, and by that I mean this. If you want to take a screenshot, take a screenshot. Not that you can follow anything there, but yeah, it's a kind of linear thing. See, if we got SBT10 and SFX30.
What do you think we'd think of that if we came back a week later and looked at it?
Yeah, that's the whole, hell, a week.
Not even an hour.
Now, I convert the video and come back and see it, and I'm like, what the hell is that?
Oh, no.
Is the entry criteria, because of what we're dealing with. Both of these have stops at -3, but risk reward, at the high end here, on average 8. Yeah, we can get 15 pips out of a 10 trade. We know that, but on average around 8. -3 here is everything from 15 to 377, with a higher average, obviously, in that 55 to 72 range, depending on the pair. So -3 here is different in both of these. So what I'm going to say here, for your convergence and for your fans, these have to be textbook, or you don't do it. Here, they can be iffy. Meaning it doesn't have to be textbook. Because again, your max risk on this is -3. And there's too many times, I'd say more so than not, that iffy trades turn out moving. And people just don't take them. Let me see if I got an example. I may or may not. That's not the one. And that's not the one I wanted. There's a wick on that. We can't see it. The white lines on the second convergence. So there's a wick up here. And the thing is, that would have shifted some of this to the right. But that's just, that's just not all that clean of a convergence. It's, we got the lower level leading the 10, the 30 is up there, and granted, probably didn't turn his charts on until, somewhere over here. I see they're starting to wiggle, so he knows exactly where. But the problem is that ends up being a good trade. And I don't want to give that up because I'm looking for this textbook perfection. But I would want that if it was a 10-minute trade only that I was taking. So we actually do have a level of slush. This is a nice trade here. That's very textbook. 4-hour trade. Look how clean that 4-hour trade is. Now, granted, the 5 and the 3, but again, I don't pay too much attention to the 5 and the 3 between themselves because sometimes they're married and you can't even see one plot on top of the other, and sometimes there is degrees of separation. It's just the way they function. But, 10, 3, 5, 1 coming up, giving us our timing, you couldn't ask for a cleaner picture. So if this was just a 10-minute trade, that's the kind of convergence we want to see for our 10-minute trade. We can't risk taking 10-minute trades that look like this. I know I don't have the other waves on here for this, but that's okay. My point tonight is in multi-wave. So we want to be very precise, SBT10. SFX30, you have a lot more leeway because you're 3 against whatever. 3 against a big number. And the mental growth the trader has to go through is just not being afraid to see that -3 on the chart. Now remember, in your snake, in your pullbacks, in your fans, just as Peter had pointed out, there's no hesitation in taking the buy into the sell. But we've got to get past this protection of -3, avoidance of -3. And it's just too literal, it's too type A, and all it's doing is denying trades. Now to Peter's point, you may get -3, -3, -3, and well, now I got to go to bed, and there's the 144 pip trade. That can happen, but yeah, that's just life. There's nothing you can do about that. That's true with any trading system. But the number we have as risk against the number we have as potential gain is good. I've not seen anything like that before.
Steve, a quick question. How would an SFX240 trade differ in your money management?
Yeah. The first range is going to be bigger, and I'm still doing some analysis and back testing and forward testing on that. In other words, that 0 to 10 range is going to grow, and it'll probably be a -5 as the manual stop.
Okay.
Yeah, and I don't know whether it'll be 20 or what, but there'll be some range in there that is larger than a 30-minute trade. I'm doing some wave 1-2 measurements on various pairs for 4-hour convergences to get a sense for that.
Okay.
Good question. And I'm going to take it out to the 480 as well. Holy cow.
What was that?
Somebody's starting their Zen meditation.
Timmy.
No, it wasn't me.
Zoe's not here, so it can't be her birds.
Well, she's on the plane.
Yeah. Yeah. So, you gotta remember, see, we've gotten so sophisticated, and, you know, when you go back, and I'm just reminded when I'm working with beginner traders and they're dealing with 30 and 5-minute charts, and I'm seeing what they're getting all day long. You know, and it's, you know, it's just a little bit more 30-minute oriented. I don't know. Let me see. This probably isn't the same trade. I don't think I have them all up here. Yeah, right here. It just helps to see what's going on. Anyway. Nope.
Steve, the new traders, what are they working with? What money management?
They had been working with the -3 entry, +6. Some of them moved to +10 here in the last couple of weeks, and
Okay.
you know, as an action line to break even +1. And so just this week, I've started telling them there's no wave reading in the 0 to 10 range, and I explain why.
Okay.
So
Okay.
just no wave reading there. You will pick up more -3s, but you will also pick up the big numbers. You will forsake some of the +3s, +4s, +5s. But we're not, you know, we're not in this game. And again, it's, you know, I have to take some responsibility, because in the process of teaching people not to lose, I convince people that, you know, you won't end up negative by having slush, because you will have plus slush to take you out. And that's more appropriate for an SBT10 trader than it is, you know, a SFX30 trader. Because the SBT10 trader doesn't have the 0 to 10 requirement. We're trading, you know, off all the waves they have. And the problem is, you know, we've kind of all made it one and the same, and that's where the mistake is. And we can't do that, because we're very good at SBT10 at flushing it out, and we're very good at getting our +8s and our +11s and sometimes more with SBT10. So we do flush out the slush, and we do make positive pips. But we can't bring that same mindset over to SFX30 and overwrite what we used to know. And especially understanding the 1-2. So we can't, you know, we can't not let that 1-2 exercise itself. The only time we can, if we don't have a PRZ or something strong to help us. If we just don't have anything on the chart and we're trading 30-minute convergences, we need to let all of them go. There's no reason we should exit on, especially because the reality is what a lot of people are seeing is a fan retrace, and calling, you know, the move down a retrace is really a wave cycle, which is why we see so many, you know, retrace of a retrace, if you will.
I'm going to text him.
No, that's all right.
Muted.
Okay. Any questions? It'll get cleaner. I'll make this a little cleaner, but most of you that have been around, I'm looking at the group here, most of you that have been around get the concept. You just have to stop treating SFX30 like it's SBT10.
Yeah, agreed.
That's the big thing. And
like you said,
you know,
the +12s, 10s, 15s are all good. You know, I'm just looking at my trade station. There's a couple of -3s, but there's not many.
Yep.
I'm going, there's a lot of -1s, -2s.
Right.
No minus, not, well, I think 2 -3s. 2, 1, 2, 3, 2, yeah, 2 -3s. The trades have been alright in that respect, but yeah, the bigger trades are, there's a lot less babying them, I think, you know, so like,
Yeah, exactly.
That's right.
That's the other thing, is it's a little easier to it's actually easier to trade.
Yeah.
Because you're not babying it so much. Mother with her little blanket protecting the toddler, you know.
Yeah. And yeah.
Yeah. Yep. So it'll open it up.
Are we saying for both the SBT10 and SFX30 trades that they're given this 10 pip sort of free zone before we make a decision on them?
Just 30, not 10.
Okay.
Just SFX30. Now, you know, look, SBT10, I mean, you'll see it once in a blue moon on 32, so I don't want to, you know, like, start giving exceptions, but what do you do when you have, you know, you have a 30-minute convergence and it turns into a snake, and you have the 10-minute snaking with it? Well, we almost always know that's going to reconverge. So anything in the short term there, you know, we have to treat more like an SBT10 trade, because that is readable. The problem that's occurring is when the 10-minute wave pulls back, it almost always looks like a retrace. And the problem is sometimes it does come down, and then it does kind of a retrace back up before it comes back down again. And that's just a cycle. And if we're always taking ourselves out, you know, here, we'll never get those pips. Never. And we'll have a whole bunch of -3s greeted by a whole bunch of +5s, and our slush will be positive for the month, but, you know, we're not making bank off that.
Yep.
And so just, you know, get over the -3. Just get over that being bad. We're not fighting for a -3. I'm not saying that. But get over seeing the +5, saying, well, I'll exit here and I'll beat that -3 at least. Because your whole focus, as Tim said, your whole focus is on the ring thing. You're focusing on the -3. You're not focusing on the 72 or the 89 or the 144. Because this number will always essentially be the same, and that's very small risk against any one of those. Now, to Peter's point, if it takes 200 of these, then yes, but it's not going to. And you just have to look at your charts and see that. So it's so easy to figure this out, guys. All you do is go to your charts. You know, go to 6 pair and go back 30 days. You know, go back 10 days at a time, or however, you know, what charting package you're on, or how much data you have, and you'll see all of the reversals at harmonic wave convergence. And so why aren't you getting all those reversals? Because it looks like the 10-minute wave is retracing, and we've kind of adopted SBT10 thinking, and we've taken ourselves out to protect that -3 or to avoid the -3, and by taking ourselves out, we're not catching those moves. And you know that's true because it's happened to everybody. Again, you know, things as a group, trader progress has been hampered by all of the SBT technology. And it's so evident when you move new traders, and you've got nothing but a 30-minute and a 5-minute chart on their page, and they're, I mean, this one old fart today I had trouble getting him going, but I really got him going this past week. And he submitted 11 trades. He had 1 minus 3. All the rest were positive pips. Yeah, I'm not talking plus 3s. So we have to get back to, if we're trading SFX30, we have to trade
that.
Yeah. If we're trading SFX30, we got to trade SFX30. No different than back in the day when people were struggling with 240 because they were afraid to give up, 35, 40 pips and let it come back to their entry point. They didn't want to give up those pips. So they'd start taking themselves out, and it's like, holy smokes, you'll never get the 500 pip 4-hour trade if you want to treat every pullback as if it's an SFX30 trade. There's going to be larger pullbacks in the 4-hour wave.
I mean, you can do a review of your own trades anyway, really, you look at them and you
Well,
go,
don't even look at your trades. The place to start is just the charts. Have the waves on your charts, look at the charts, and look at the convergences and say, why didn't I get these pips? What about, how I'm trading the system is preventing me from getting those moves? Or taking those moves and transferring them into positive pips. Because the moves are there, and multi-wave identifies the move. So it's your use of the waves and your money management after that that determines what pips you get. But the moves are there. Harmonic wave convergence is noting them, and they're good runs. I don't know. I'll probably look and won't find anything as an example. That's a 4-hour move. That's a 4-hour move. I don't think I have any of the 30s left that I did on it. But look at that. Even if you take the moves that would have backed out, I mean, that's real close to 50%. So let's say we got taken out there. Oh, no, that's all right. Too late. Let's say we got taken out there. 19 pips. Okay. What about these moves down here? No 50%, no 50%, no 50%, no 50%, no 50%. This is a 4-hour move on a 30-minute entry. 82 pips. This is a big 1-2 move. People should recognize it for what it is.
Yeah, I took a Fibonacci from
103. No 50%, no 50%. It's another 70, 80. Nope, 59, 60 pips. They're there. Just like I showed you with the Aussie pitchfork when we were looking at it, the other day, all of these trades, thanks to the pitchfork, but all these trades. I think it was 120 pips in 36 hours. Easy, 120 pips. You're not going to catch all of them. Like Peter says, you're sleeping, you're at work. But, this is one pair. So all you have to do is look at the charts and say, why didn't I get these pips? Why didn't I get these pips? And sometimes, it's too much focus on the 1 minute, and we're not even glancing at the 30-minute to see what the hell's going on. So, looking for some people to step up and be SFX30 traders, just with solid money management. Now, nothing wrong with trading SBT10. You'll make good pips with SBT10 if you're methodical and consistent, because you can look at a 10-minute chart and see all it coughs up too. So you have to say, why am I not getting these if they're there? What do I have to change in my trading?
Yeah, I see.
So don't worry about your own personal trades. I mean, you can look at them to see what you got. And if the biggest thing you got in this stretch of 3 days on the Aussie is plus 5 pips, then you need to look at this and say, what the hell am I doing? There are too many trades there. Proof's in the pudding. record the session.
No, no.
That's all right. It was kind of, it wasn't as linear as I wanted it to be. It was all over the board. Like I said, I'll revise this a little and make it cleaner, because I do want to end up with a one-page document covering everything from how tight does it have to be, how loose can the entry be, you know, to how you interpret the fan, SFX30 versus SBT10, how you interpret the fan and your actions based on, you know, are you close to a PRZ and you're in a snake, you know, there's no reason to stay in those trades. Just go ahead and take the pips, you know, past 10. Get out at plus 10.
I'm pretty sure Gary would have
Recorded it? Yeah, maybe he did. Now, you know, what was I going to say? Had to do with tightness of the entry or tightness of your trade again. And I lost my train of thought. Anyway, yeah, lost my train of thought. But, you know, remember what we're doing, though. And, hey, remember way back when. You know, don't have anybody really from way back when. But SFX30, for the first couple of years, and, you know, the first target could have, you know, it just depends on where the harmonics were, but that first target could have been 34 pips out, 21 pips out. So we essentially had your entry, you know, back 20 up to 21. So you want to talk about a zone that floated.
And what then? Then you moved it to plus 1, did you?
And now it went to plus 10. It went to plus 10 when we brought in SBT because there was just no need to have a 20 pip stop loss. But in the early days, that's what it was, set and forget. And you know what? People made a lot of pips. But we just don't need that anymore. You know, we've got the tools and understanding what's going on. You know, in reality, if
What? So sorry, I don't want to break your train.
no, it's, you know, if price, well, let me go up because I like drawing about that way better. If price is moving up and we have a convergence and it ends up being, you know, it starts to pull back. If it's going to go back above the point of harmonic wave convergence, this convergence is no longer valid. So the assumption was it could come up to minus 20 because, you know, this was the old, you know, the old school of thinking. If it came all the way up here and turned around here, you know, why would you want to exit down here and pay the dealer twice and, you know, blah, blah, blah. And the assumption was the next turnaround would be up here. The trouble is, you know, if it's going to start snaking on you, 20 pips is nothing on an SFX30 trading. We'll just go past that stop loss too, right? So it really didn't matter. But the bottom line is this first convergence is over with as soon as price goes beyond it. So instead of writing all this negative, let's just wait. Maybe it's at 10 pips, maybe it's at 15, maybe it's 25 before we have the next convergence. Then we re-enter the trade. So that's why the minus 1 makes sense. But the set and forget, you're kind of just hoping that a second or third final harmonic wave convergence all occurs in that, you know, zone between your former harmonic wave convergence and your 20 pips. I mean, that's not really much trading. You know, it's just, So we went to 10 with SBT because we said, hey, we have the technology. And then we eventually did, with the math, we're able to bring it down and say, it just makes sense, get out, because this convergence is no longer valid. But then you have to stay with it, Now, I'll tell you what a lot of traders do. This is, by the hundreds I've seen this, literally. So we have a move up. We have a convergence, right? I know people are going to, if you say this hasn't happened to you, then you just haven't taken 20 SFX30 trades. I mean, that's the reality here. So what happens is, in multi-wave, we had a convergence, and let's say it's a fan, it's a snake. Well, it can't be a snake if the price is pulled back that far. 30 wouldn't pull that far. Well, let's say it's a retrace. So we'll call it a retrace, a 30-minute retrace. And we see the 10-minute wave pull back and all the way down to the 1, And so we had valid reasons to say, me, had valid reasons to say this is the time to exit. So we would exit the trade. Because what's this? Retrace. What's retrace mean? Same thing as snake in the grass. Wrong time to be in the trade. We're just going to ride this down a little easier than we would a snake, but we'll collect what points we can. When the retrace has gone to its extreme or to its exhaustion, we can exit the trade. So they exit the trade down here on price, and then price goes back up here and then drops 100 pips. And they say what? It never reconverged. Because what happens down below is the 30-minute wave after the retrace, and let me draw the retrace a little steeper so this makes more sense. And this is funny when you think about it now. So, pretty steep retrace, and so it comes up here like this and then goes. And they exit it with the intention of getting back in, but Steve, it never retraced. Well, this is a trade you're just going to have to figure out. Because what's happening? 1, 2. It's not going to reconverge on a 1, 2. It's not going to reconverge when it's made its mind decide to go down. So whether it's a retrace or whether you can't read it, and I'm not saying this isn't a legitimate exit, especially if you're way down here in our current technology. If this is at 15 pips and you can clearly see this is disproportionate, then you can, it makes sense to exit. But now you have the understanding of 1, 2, which means you're not, you have to allow it to come all the way up to this line, but you no longer can expect it. And yes, a retrace should go up. But now you got to get back into Elliott wave, and I'm going to lose some people here, I know. But when we come up to the end of that top, let's call it a 5, and we have our correction. What's that? That is the retrace of the move up, right? That is the retrace of the move up, and we're going to see that in our blue wave. But what happens inside that? What happens inside that, of course, is we have a 1 or an A, B, C. And guess what? That is a retrace. So we see the entire move here. I have to circle the whole thing in that oval, like Mark's picture. So that whole oval is the retrace of the move up. So we saw a retrace down here to this point, but then we see this retrace and a retrace. So you can have this end up being a fan up here, and this is what's confused us. Oh, what is that? Should I enter that? Is that a fan retrace I can enter? Well, oh, we can't because it's not coming from a convergence down here. Well, it's just a big cycle, or it's an ABC that's going deeper. Or it's just the 1, 2, because inside this move out of here, which can be impulsive, the 1 to 2 move is a retrace. This isn't. This should be proportionate to some extent, but this is going to look funny then. But the bottom line is, so many people would exit down here, and then, hey, I got plus 15, but it went down to 100. As if, oh, the system's bad because it never showed the reconvergence. Well, price never went to a higher high. How can it converge? And the reality is this is just the 1-2 move. And it's just with scale, it was enough to where, there's distance here that's visible. If this is 15 pips down, this could easily still be, 5-6 pips away from the line. People are waiting for it to converge. And then they miss the trade. Now you have to see it for what it is. If you exit down here on a fan retrace on this move after a convergence, you have to watch this. And going back up, if it falls short and starts to turn around, you may not have, and this is where your understanding of what we've been going over the last few weeks, you may not have a reason down here to take this trade. Hopefully this would be a fan retrace, but I've scorned so many people on that not being a fan retrace because fan retraces come from convergences. Right? So, but there's a lot of people before we really got heavy into fan retraces, they just saw this as a retrace exhaustion, and they would wait for this convergence because that's what's supposed to happen. Hey, it's supposed to go up, retrace, supposed to go to a higher high. They don't expect that to be a 1-2 move. So now it could be a 1-2 move. So you might not have a totally clean view of this being a re-entry. But as soon as it whips around on you, it's worth it. Now, guess what? Can that be a -3 entry? No, because you do have to protect yourself from it being something, crazy like that. So you still have to go 1 pip on the other side of the original convergence. So this might be a 4 or 5 or even 6 pip stop loss. But again, what is 6 against 100? What is 6 against 50? And you have a lot on your side at this point in terms of percentages and understanding that 1-2 move. Anyway, when it gets down to it, it's not rocket science. It's just stringing together the logical stuff. Was that a sigh?
Yes, it was. It was a sigh.
Yeah.
Yeah.
It's not really that complicated. We made it a little bit more.
I tell my wife that all the time.
Yeah, right. Well, I will be interested to see trades posted in the FXFX group from here on out.
Okay.
On 30-minute trades. On 30-minute trades, and we'll see what happens.
We will.
See what happens. It's kind of changed my perspective, and I've been doing a lot of scalping here the last several months, and I haven't taken as many 30-minute trades as I should have, to be honest. So they're back on my list. Big time.
Yeah, well, just maybe the time. The time. Yeah, it's just time on the charts really when you're taking.
Yeah.
Scalping, like you can have with the 30s, you can have an alert. It brings you to the chart. Bang! Oh, thank you very much. So like, if you got alerts on the 10-minute P10, it's going off every freaking. Excuse me. If you've got a few pairs with it on, like it's binging and bopping the whole. Yeah.
Yeah. Well, and this is where pitchforks and scanners come into play.
Yeah.
Because you could be on the lookout for as many scans for pairs you cover. And I know the way the IML scanner is set up. We get everything. We don't. There's not a large selectivity ability. And so you may not have charts at the lower levels for all the pairs that show up with scans. But even for the ones you do have, the pairs you trade, You know, to note as many scans as you can is great, and I'm going to stay quiet at this point on that because there's going to be some enhancements and changes there that are pretty cool here coming up.
From IML,
yeah,
from
just in general.
Yeah, okay.
Yeah, just in general. But the emphasis, you know, if you want to look at, you know, what's the next quarter emphasis, it's going to be on PRZs, so people have the ability to catch 4-hour and 30-minute trades.
Yeah.
Not taken away from those that love SBT, because a lot of people do love SBT, but I'd like to have some more 1,000 pip contests.
Oh yeah.
The other thing too, let me finish this. You know, what if you're not sure? So let's say you're in that scenario where we've had some, you know, we've got a PRZ. Let me start at the top. So we've got a PRZ, and you know, we're on our way there, right? And so we have a harmonic wave convergence right here. And we're looking at that and we're going, you know, dang this thing, you know, it's snaking on me, or it's pulling back and it looks like a retrace, and, you know, do I get in, do I get out, right? And we say, let it go, let it go, let it go. You know, let it play itself out. Or we say, no, exit, because it has to go up one more. So if this is pulled back, let's get those pips, assuming it's pulled back to Peter's correction. You know, it's pulled back 10 pips. You know, and we see the distance here, and this isn't 50 pips. You know, well, guess what? You know what drives your sight curve to look like that is when you're making either or decisions. Wow, that's a terrible or. O R. So when you have to make either or decisions. So look, is there anything wrong with, because you know, if you've been banking these along the way, right? Because you see the PRZ up there. What's wrong with taking 10 with 50% of your lots and letting the other 50% stay in to see this thing go back up and go higher? The money management, because as always, when you split your lots like that, you win-win. Here, you're either going to win or lose. And by that I mean, if you take your pips here and you exit, and you know this thing does end up turning around on you, despite the PRZ being there, because PRZs do fail, and goes 110 pips, then you're upset. You kill yourself. You're upset. Kick your butt. All right? Because in that sense, well, you did pocket 10, but you're going to see the opportunity cost of 110 as a loss. It was a loss in terms of opportunity cost. All right? Or, you know, you take the 10 and it does go back up and it does go the higher high and it does converge in there, and then you get in and let it rip. Well, now you won. This was the right decision to make. So it's either you lose or you win. When you go 50-50, it doesn't work that way. You know, because if this turns around and goes south, you know, you still got lots in that trade. And you don't mind that, you know, well, yeah, I know some of them went out at 10, but wow, you know, I got 100 on the rest. And likewise, if it continues up and you took out 10 there, you know, 50% there, well, then you ride that up the rest of the way with 50% of your lots. So
if
you win there too. So these are both wins.
Yeah.
So now your sight curve.
Yeah, go on, sorry.
All right. Anyway, so legging down is a good strategy to facilitate growth and more so station of your mental game.
So with the legging down, okay, So if you're going to do that all the time, say hypothetically you did that all the time, does that mean you could double your lots? Could you theoretically double your lots?
No, because there will be some points where it's just blatant. You've got to make one decision or another. These are the times where you're hesitant to commit to an either or.
Yeah,
what if I do this and it does that? What if I do this and
Yeah.
it does that? Or what if I do that and it does this? And you're just hesitating. So you just do that, and it evens
Okay.
out your psychic because you're going to win either way.
Yeah.
And now when I say win, I mean it's a compromised win, but at least you're winning all the time, which like I said, stabilizes the psych side. It's only when it's either or.
How is the win when the price goes back up? Because surely that's eroding the pips you've taken out.
Well, when you say win, and what I'm talking about is the times where your decision in what you do is an either or. So in this particular case, did I map it right or wrong? I don't know. In this case, in this case, the either or here is if you exited this trade. Or, no, you stayed in the trade, excuse me. The win here is if you stayed in this trade. Because then, well, no, the win is if you exited the trade. The win is if you exited the trade.
You're counting it on doing a 1-2 there.
Yeah, you can't. No, look. Wow. I'm either going to stay here or get out here, right?
Yep.
If I stay here, there's a 50-50 chance I'm going to win or lose.
Yep. Okay.
If I exit, there's a 50-50 chance I'm going to win or lose. And the trouble is you can't lose on both of these. One of them's always going to be a win. Price has to go one of those ways. And by splitting the lots, 50% of them aren't going to work. The other 50% are. That's why it's a combo.
So the 50% that work are if it's a 1-2 move.
Yeah, you've called them a win when one's a win and one is just neutral, isn't it?
No.
If you got out when price went back up to the harmonic wave convergence,
No, you've still got half
that
your
would
lots.
be neutral.
Yeah, but you've still got half your lots. You've still kept half your lots with that. The thing is to take yourself out when you're at break even +1 or -3. Which one is it, Steve?
Right.
And if it's a win, if it's a 1-2, if it's a 1-2 move, it's a win that 50% of your lots you're still in the trade and it's going down.
Right.
Is that right? That's how I read it.
You can't both these can't be losses.
Yeah.
No, by the same token, they can't both be wins.
They are because you only have 50%. 50% is going to go out.
Yeah.
The win here, Mark, is I took 50% out at +10. The other 50% go out at -3.
3. Yeah.
Which is your +7.
So I win because 50% of my lots are +10. I don't have 100% going out at -3.
You got a +7.
So that's a win. 50% of my lots at +10 because I took them out. You're doing both of these things. That's the difference. You're staying and you're exiting. This is no different than this. This is the same concept as a CBT.
It is, yes. Yes, because it's 50% of the lots that go back to zero.
Right. Exactly. It's to say the CBT, Dodd-Frank, they want us in America to make a decision right there. You either have to get out or you have to stay in.
Not Dodd-Frank.
Yeah, Dodd-Frank.
Don't.
Mark, humor, I swear.
Going there.
Funny. Yeah, so it does balance out because you just don't you'll kick yourself, some. Gee, I wish I took them all out. Gee, I wish I left them all in. But the bottom line is you're still smiling because it's like um, it's like you've gone against Goliath and you tied. You didn't lose, and it's those things sometimes that when you don't lose, even if it's not a huge victory, but the fact you didn't lose, that in itself is the victory. And that's just like this site curve here.
Yeah.
Yes, and of course you left yourself open for the big win.
Right.
That's exactly right.
Yes, there's always the potential for the win to be really big. And yes, you'll kick yourself a little if it wins big, and then I shouldn't have taken those other lots out, but so it works both ways. But at least you win each way. You win a little each way. You're going to win a whole bunch one way maybe, and win a little the other way, but they're both wins, and that's what makes it nice. So the legging down.
Yeah, and as your account balance grows, then that 50% left in is actually obviously worth much more in financial terms, isn't it?
Yeah, sure, exactly. Absolutely. And you could do things. Look, we've talked about this too. Here's another good case of where you can use this strategy, but I wouldn't use it 50-50. So I've done this plenty of times, and this is just shy of doing a CBT. But it's it's a variant of that. So I've got I enter a buy and things move up and there's been some pullbacks, but they haven't gone 50%. And this thing rides all the way up to another convergence, right? So price goes up to another convergence point. And let's say pick a number. Let's say that's 84 pips.
55.
Yeah. So one thing you can do is if this is hard to tell, at this convergence point, don't exit here. Or what you would do is, when I say don't exit everything. Exit 75%. See, I go beyond 50 in this situation. Exit 75%, at your plus 84. And leave 25% to ride. Why? Because this thing may be snaking and it just goes on up higher. Now, of course, so it ends up being a slight CBT, but it's not an equal hedge because you only have 25% going up, whereas you have, another 2% coming down this way. But it's just something you can do. What if this is a type 4? Boom. 25% of my lots just got the extra ride. And now I move my stop way up. I'm not going to stay at 50% anymore. I might come up to 70%, 75%. So even if I was wrong, these extra 25 are going to go out at plus 70. See, I don't consider that a loss. Yeah, I gave up 14 pips, but I'm looking at this to the positive. Hey, I got 84 pips on 75% of my lots and 70%. And 70 pips on 25%. Win-win. Versus, again, making this point either or. But that does require the stop to go up. Because you want to, you just want to secure that a little bit more. But I wouldn't go 50-50 on that, because there's just too much odds, But there's still a little room for it to go up. It could be a T4. It could be a snake in the grass. It just depends on how you read the momentum in here and, what else you might have to help you identify. Maybe there's some heavy...
Hit a PRC on it, mate.
Yeah, exactly. Maybe there's some stuff up there that makes sense, and even though we have a convergence here, we surely don't want to keep 100% of our lots in when we're getting a signal that it's reversing, So sometimes there's some reason to let something stay in there just in case. But that's another example of where you could lay down. I just wouldn't do it 50-50 there.
Quick question about the hull. So which hull are you using on SFX30 once
30
you've
minute.
gone beyond your sort of 25 pips?
Yeah, 30.
Okay.
It's got to turn in our direction. You know, I mean, you can have a convergence, and obviously it doesn't turn right away. In other words, it's still tracking red on the way up here. You know, just depends on how big this move and what happened to the left. But we have our convergence, and this thing is still tracking red. It's, you know, at some point it turned to green, but it's not down here. So once it turns green and it moves, you know, I like to see 10 or 15 pips of it green on a 30-minute chart. Then I'm comfortable in just using that. The hull is great. The hull is absolutely great. I've looked at so many systems for reversals. Oh my God! And you know, because we don't have everything, I looked at. I mean, I programmed in IntelliScript. I mean, I spent dozens of hours doing this. This is what, you know, like, people don't understand all the time. I spend dozens of hours. I programmed 5 different versions of SuperTrend. You know, SuperTrend is not available on IntelliCharts. So I program, and version by version, you know, once I finally got it to work, it's not that complex of a formula, so, but, you know, you want to test it on several pairs and several different time frames and whatnot. So I got the SuperTrend to work, and there might have been, at most, a 1% to 2% difference in all of those versions against the Hall 21.
Really? Wow.
Yeah. So it's like, what the hell? Why bother? You know, I mean, this is really powerful. This is really powerful. Now, you know, there's give and take in the Hall 21. We proved that in LFX, you know, in terms of the move sometimes. But put it this way, on a trade where you have 2 options, where you're trailing the gain by 50%, your Hall will protect you and always take you out before that. So it's not going to come back this far. The Hall will always take you out somewhere in here. Whoops, that's supposed to be red. So it's better than the 50% by a long shot. And it takes a lot to throw it off, you know. Now, will it sometimes flip and you know, price turn around and go the, yeah, you know, I mean, that, again, that's part of trading. But for the most part, it's really good and it's simple. Once we got FXtract to fix the version from our script and get it to look like our script, it took about 3 months to get that done. Yeah, it's a great tool. It's an absolutely great tool.
But the 50%, using the 50% with you know, with a Fibbo, I like that because you can put that in the trade station or something very close to it, and that is giving you a figure, a stop figure, in advance, isn't it? Whereas the hull, you don't know where the hull's going to turn around. So
Right.
you can keep ratcheting up the 50% as price goes up.
Yeah. But come on, you're smarter than that. So what you do is you look at 30-minute charts, and you find, you know, pick a pair, Euro, and you look at 10 Fibbo, 10 Hall 21 reverses, and you put a Fibbo on it, and you find out it's around 23.6 of the entire move. You know, it's between 23 and about 26, somewhere in there. And then go do the pound and go do the Aussie, whatever. And so now you got the same thing, Mark. So all you do is you say, well, if it's that far, you know, I'll just call it 30. So I've got my run. I put my Fibbo on. Here's my 30 line, and I just put a price alert above that. So as it comes back, it goes through my price alert. Now I know I'm getting close to the Hall. We will eventually have a Hall flip alert, but it's complex. because of the nature of the hull to begin with. And then to do the flip changes, it's a lot of code, and there's just stuff I'd rather do. So that's a simple way of doing it. You can estimate where.
I'm not saying not using the hull, but I'm saying you can have the 50% added into your trade station or on your chart as price goes up, so that is your emergency stop loss, because you can see where that is at the maximum price, can't you? And then the hull comes, as price comes down, hull comes down with it, and you don't really know where that's going to turn because it depends how quickly prices come down. So
it's a range. I'm telling you, it's a range. You'll see it. Go look at 10 euros, 10 pounds, 10 Aussies, and there's a range. You'll see that in the normalcy of moves, it's going to be there. Yeah, if I have, a 150 pip candle on an announcement followed by an 80, an 85 or 100 pip reversal, a lot of things get messed up. A lot of things get messed up. But normal moves, the hull operates in a range. You'll see that. And, hell, for approximation purposes, if you don't want to set an alert, just put, the average of that range or the far end of the range. Put that in as your absolute stop loss in your trading station, just the same way you'd put the 50% in. The hull will take you out before you're 50%. And quite frankly, we're not talking about the difference between, minus 20 and plus 20. Here we're talking about, if we've gone 25 or 30 pips for the hull to flip, and we go up another 25, 30 pips in the trade, now we're at 60, and now we start arbitrating between 25 and 30% of the which is the range for the hull, whatever.
I'd agree.
The numbers you're talking about are small. 5% of 60 is what? 3 pips? So if you got taken out 3 pips earlier, 3 pips late, what the hell? It's just not worth. It's not worth being that, technical on. So you can approximate it the same way. And like I said, you'll get an idea. I haven't done it in a while. I did it when we first brought it out, and then I did it about, I don't know, time's gone so fast. I want to say about a year. It's probably been 2 years. I did it about 2 years ago. I did another one of these just to see about the ranges that it was. And when you do 10 and you do 10 and you do 10, you'll get most of the moves covered in there, the quick retraces, the slower retraces, and you'll get a range that's pretty consistent. And like I said, for the most part, you can do that. It'll be better when we have the flip alert, I guarantee you. You're right. But until then, there's ways of doing it. You can either put an alert on the chart, or you can just program it as a retracement value if you want to do that. Like you're going to bed or you're going to work or whatever, and you can't babysit the chart. Because granted, you only see the flips when you're on the chart. The difference with the hull is unlike your 50% retracement, and even unlike, if I use 30 and I get a number and I put it in my trade station, those are real-time hits. Whereas the true hull is closed. And I have seen pullbacks like this, which while I'm watching it, turn the hull from green to red while I'm watching it, and inside that half hour, it turns around and goes back up, and the first candle that closes, it's still green. So it went red in real time, but the hull exit is only on a closed candle just because of that. So unfortunately, that's why you can't do it with just straight percentages and get 100% accuracy, because when you hit 50% in your trade station, you are out. It doesn't say, well, are you 5 minutes into the candle or is this the end of a candle? It doesn't care about time. It just cares about absolute price. I should say absolute price here. Absolute price in real time. Yeah. But that's close enough for government work. Like I said, most of the runs, it's not worth the quibble. And it's the easiest, best mechanism. And like I said, I've run it against so many things now that it's not. The Super Trend excited me because it just sounded so good, and it's used in a lot of systems. But when all's said and done, it's no different than the Hall. I mean, they're only 1 or 2% apart on trend turns. All right, well, I'm going to call it a night. We've had enough, and I didn't record any of this. So for those of you that attended, hey, you got some bonus here that nobody else got, so thanks for carving time out.
Gary's got it recorded, by the way, so...
I recorded
okay, well, maybe we'll figure out a way to get that up.
Unmuted.
Let me think. Oh, there is a webinar tomorrow night for those who can make it. Pretty big announcement. That'll be 8 p.m. Eastern.
So
You get married?
Yeah, try and record that one.
Oh, good one. I heard that.
I'm wondering why the laughter, though. That's kind of funny. I may be a troll, but not that much of a troll, you know?
No, I didn't mean it that way. I just, it wasn't what I expected. More.
Yeah.
Sorry,
Nice.
That comment was very left of field to what I was seeking.
So, you know, look at the personality distribution we have here. I mean, you know, we've got Mark with his dry humor, his sarcasm, and we get Tim. Tim never says good or bad or whatever, but he'll laugh out loud.
Yeah.
It's like Tim can't hold it back. I love it. I absolutely love it. Y'all are crazy.
All right.
So,
There you
so that's 10 a.m. our time tomorrow.
I don't know. You tell me. I had to take the clock.
You work it
out of
out.
We'll work it out. We'll work it out.
Yeah, you work it out at your end.
Yeah,
You know,
okay.
turn your clock, hold your clock upside down, and whatever
Something
you do
like
down
that.
there, tell them. So, yeah.
And
All right. For those that can
will
make it, I'll see you tomorrow night. If not, I'll see you guys in Facebook land and/or next Tuesday.
Thanks, guys.
Bye.
Have a great weekend.
Thanks a lot.
And girls.
Thanks,
If there's any
guys.
girls, yeah. Okay.
Cheers.